Speak. I see we've got Andrew Lee live from the beautiful city of Frisco, Texas. And we are graced by the Honorable Trevor Thompson, which is rare. And for those of you that don't know Brandon Height, he's a incredible land guy, not lending guy, just, oh my goodness, is that Mike DuBois? Mike, how are you doing? Adrian, good to see you. Yes, I'm the pregame warm-up. We're waiting 2 more minutes for everybody that's stuck in traffic, going from your home office to the refrigerator, then back to your home office, like I did. Bryant, good to see you. Love freaking people out when they're not expecting someone to call their name. Do want to thank everybody for hopping on and listening to our take on what's going on, and then we're going to talk about what's going on in the economy. We're going to talk about kind of what we look for and what we're looking for from existing multifamily in today's markets, and then what we are looking for, and pretty much in line with a lot of our clients on the new development side. And I may touch for just a brief second on the wonderful world of lending. I hope there aren't too many brokers on here that get annoyed with me. But John and I right now spend approximately 29 hours a day talking to lenders and brokers. It's not an exaggeration, right, John?
That's right.
Yeah. So let's see, give it like 2 more minutes. Who's going to win the Super Bowl? Eagles? That's what I thought. Not shake your head if you don't think the Eagles are going to win. And it's not that I'm for the Eagles. I just think they're going to win. Nobody cares. That's great.
I'm a Cowboys fan in Eagles country, so I have to say the Eagles can't win.
Full disclosure, that person talking right now says she's a Cowboys fan. She lives in Chocolateville in Pennsylvania, so she doesn't get to pick a team over here. She's either a Steelers fan or an Eagles fan.
I grew up a cowgirl in Texas. I'm actually a Texan, even though Merrill says I'm a Pennsylvanian.
She lives in Hershey, Pennsylvania. Anybody been there? I knew Mike had been there. Yes. All right, 30 seconds. Merrill shuts up. I promise they made me talk to you guys. Nobody else who's hosting wants to talk right now. Steve lived in the area. Steve lived in Hershey. Population of 10, and 20% of the people on lived in Hershey. See Emily, Daniel, Lawrence, Allie. John, do you know Allie? John's on mute. Good. All right, Jeff. Let's bring up the first slide.
All right.
You guys ready?
Yep. Give me a sec.
Is that the first slide? Here we go. You kind of already know you're here for the webinar, and that we're gonna kind of talk to you guys about, again, what we see in the economy, which we're gonna keep very brief because that was last month's webinar, and not a whole lot's changed other than the Fed's only raised rates by 25 bips. And of course, they lowered the amount they're going to raise. And then they also tell you right after that, we're going to be very aggressive. We're going to keep fighting. And this is not the end. So I just posted something about it. So the Fed is saying one thing and their actions are something else. So all that does is creates more anxiety with lenders and increases the spread. But I'm not going to talk about lending today. So real quick, you've got myself, John, and Anna. Kind of be your host today, talking about the topics. And then please, if you have any questions regarding what we're talking about, post them in the chat, and we'll get to them towards the end. Any questions you guys have on what we're talking about, real quick, I'm Merrill Kaliser. I'm a real estate lawyer and a SEC attorney. We've got our own firm here in North Texas and represent, quite honestly, quite a few of you that are on right now. And typically we represent about 300 plus or minus multifamily storage unit, storage facility, or hotel or development projects a year. We work on the commercial real estate, and then we also work on the syndication piece, SEC work for everybody. John will introduce himself and go over the numbers real quick, and then we'll have Anna complete the bios.
Great, thanks, Merrill. Thanks everybody for joining us tonight. My name is John Monteiro, part of Revision Masters. Excited to do our second educational webinar. We are planning on doing these hopefully every month, scheduling permitting. So we're excited to dive in here in a second. Very quickly on me, I am also based here in Frisco, Texas, and husband, family of 4 daughters, moved here in 2009 from the Bay Area in California and Hawaii prior to that. It's been a great moving to Texas. We've got a lot of out-of-state people moving here over the last decade. We'll continue to see a lot more people moving here going forward, but we moved here for opportunity, especially in the real estate space. So I've been doing full-time real estate, primarily focusing on multifamily, both in terms of acquisitions as well as new development projects, and have close to 12,000 units under management, both active and sold. And then on the new development side, just over 4,500 units of projects that we're working on in the new development space. So it's a great place to be, and we invest and do projects where we live. So let me hand it over to Anna.
And where I used to live. So as we talked about, I'm an original Houstonian, also spent some time in San Antonio, Texas, where most of my family lives today. I have a background in the institutional investing world, where I worked in private banking and product development for AIG and Bank of America, where we worked on products for high net worth individuals, banks, and institutions. On the side, I started a side hustle in real estate back in 1998, bought my first property, and now I am primarily a multifamily syndicator. I've joined Merrill and John as Chief Strategy Officer for Revision Masters, and we're excited to continue to do business in Texas. Jeff, next slide. So I've got the first one, and I just encourage you, as John said, to plug into these webinars. We did a webinar last month where we really dove deep into our outlook on the economy. So I won't spend a significant amount of time, but I will touch on just a few key points. And that is that most likely, most economists now believe that we are heading toward a recession. Whether one is actually called by the NBER that dates recessions generally 6 months after we're already in one or not, what we can see is that many factors of growth are pointing toward recessionary conditions in the near future. So supply chain issues from COVID, Russia's war in Ukraine is really leading to a focus on deglobalization and moving energy, food, semiconductors, and tech back onshore as a matter of national safety and national productivity. And with that can come some inflation. Cal has said today, if you didn't listen to him, I encourage you to do that, that the fight against inflation is nowhere near over. And so while we may seem to have a healthy economy when it comes to jobs and wages, that is exactly the thing that the Fed is going after in an attempt to kill inflation. They're trying to prevent a wage price spiral. And by doing that, they're going to continue to raise interest rates and keep them restrictive long enough to create enough layoffs and enough wage compression to hopefully bring inflation back down to 2%. As that happens, layoffs are starting, and we expect that they will continue, especially in the tech sector and the financial sector. And as rates go up, housing ownership becomes more and more unaffordable, which really pushes demand into apartment rentals. We believe that these continuing increasing rates until we are in recessionary territory will continue to slow construction. It's having a significant tightening on the credit markets, as Merrill just mentioned. But what's really important to keep in mind here is that regions vary in terms of how impacted they are by recession, and certain asset classes and locations of the country are much more resilient to recession, inflation, and any other type of economic pain. So a few key points on recession resilient investing. One is to remember that recessions, generally speaking, are short term. The average recession lasts only 10 months, followed by about an 18-month recovery period. And so in the short term, we need to really be focusing on asset preservation, but also looking for opportunities for growth, that when we're on the other side of this economic pain, recession, and recovery, within the next 3 to 5 years plus, we're really hoping for long-term growth and looking for opportunities that provide that growth at the same time that they provide some asset preservation today. Recession resilient areas will perform much better during a recession, post-recession, and recover much more quickly. And those are areas, if you look back historically, that have a couple of key fundamental criteria. One of those is a very diverse and plentiful job market with strong wages, population growth, great schools, low crime, and areas that have a lot more housing demand than they do supply. Those are going to keep prices in rents and values up. We also want to focus on assets that are proven to be recession resilient. And our focus primarily is on multifamily, which has been the most recession resilient asset class during the past several recessions. And we believe it will continue to be. And the last point is that we really need to focus on long-term perspective. It's very difficult to determine exactly where we will go on a short-term basis. The Fed doesn't have it figured out. Economists, the credit markets don't have it figured out. But what we do know is that once we get through a couple of hopefully months or years of economic pain, we will generally start to have a recovery again. But keep in mind that as labor force participation continues to go down, as population growth continues to come down, that typically slows growth. And when growth falls, rates fall, and cap rates continue to fall, boding well for us when we're looking for increasing values over time.
Right, next slide, please, Jeff. I think I'm next. Before I jump in here, just a couple other housekeeping items. So everybody that signed up for the webinar, whether you are on with us live tonight or could not attend, will be receiving a copy of the recording that will be sent out to your email address tomorrow. So please keep an eye out for that. Also, we're going to run through these slides briskly so that we can have enough time at the end to answer any questions that you may have specific to the presentation, or just anything in general specific to Texas or multifamily or the economy in general. So if you do have questions, feel free to add them into the chat box. Jeff will be monitoring those, and we'll get to those at the end of the presentation. So I'm just going to jump right in as to why we continue to like multifamily. I feel like I've been saying this for over a decade now. It's really the same story for the most part as it relates to the macroeconomic trends of the housing imbalance that we're seeing across the country. These slides are from Marcus and Millichap and IPA, a big one of the largest brokers in the country in the commercial real estate space. The first bullet point here is exactly showing the slide at the bottom right, the significant housing undersupply that we have in this country. These are national numbers, and if you kind of drill into Texas, it's even more pronounced with all the job and population growth and in-migration that we're continuing to see in the state. So with that undersupply, obviously massive demand, whether it's single family, multifamily, and all the in-migration that's occurring, there's a huge population growth and housing imbalance. The second thing on the bullet point here is that we continue to see record demand in rents, which is leading to all-time vacancies in not only across the multifamily portfolio across the country, but also here in Texas as well. So that's the graph at the bottom left. You can see that that's the vacancy level has continued to fluctuate up and down, but over time, you can see that we are at record levels of vacancy or occupancy and a vacancy rate of 2.4%. And the last bullet point here is the housing affordability. Anna had mentioned this briefly earlier. You can see that the orange line versus the blue line is the spread between the cost to own a home versus the cost to rent. And you can see that there's a huge spread that we are seeing here, $904 a month between owning a home and renting. So that benefits us as apartment owners because, again, it is becoming fairly unaffordable for two reasons. There's been a huge run up in single family home prices over the last few years. That's obviously softening today, but still at record highs. And then you layer that on with high interest rates. I think we peaked earlier last year, sometime last year at 7% mortgages. That's fallen off into the sixes now, but still extremely high relative to the last previous years, making home affordability out of reach for many families. Next slide, please, Jeff. And here's a little bit more on what I mentioned previously around rent and population growth. So the graph, the map of the on the left-hand side, in red, those are markets that are losing population, and those in green is where we are seeing increases in population. Obviously, we're focused primarily on Texas, and you can see that all of the major metros are highlighted in large green circles, which means that the in-migration has been and continues to be extremely strong. Then with the graph on the right-hand side, you'll see again that rent growth has been robust over the last few years. Rent is definitely tapering off in terms of rent growth year over year, but still we're seeing significantly rent growth, again, in a lot of our multifamily portfolio here in Texas. The difference between the three lines is A class, those are newer luxury properties. B class is kind of your 80s, 90s product. And then the C class is your true workforce housing. You'll see that the rent growth is strong across all three asset classes, but struggling a little bit in comparison to the A and B class assets in the C class workforce housing sector. Probably in regards to, again, that demographic in a softening economic environment really gets hit first, especially during this inflationary time where a larger percentage of their paycheck goes towards food and gas and all of the other things that are costing a lot more money today than it was a few years ago. Next slide, please.
Okay, so I want to talk to you a little bit about why multifamily, in addition to the things that John just discussed. And one of the things to keep in mind is that when we're looking for investments as investors, we're not just comparing Class A, Class B, and Class C multifamily or multifamily in one region versus another, but we're also looking what the returns are relative to other investment options. And what you'll see is that over time, multifamily is very competitive relative to returns for other alternative investments. And so if you look at treasury yields in various countries, you'll see that they're significantly lower, especially in countries like Germany and France and even the UK, than what Class A institutional level cap rates are for multifamily at 4.4%. It's better returns than US Treasuries, better returns than these other alternatives, and than S&P dividends. And that does not take into account our ability to force appreciation. It's essentially a turnkey property still yielding better results compared to other investments. It's also important to understand that when you have volatility in the economy, multifamily investing has generally been a preservation of capital or flight to safety asset, where people leave more volatile asset classes like the stock market, like even the bond market, and they move into assets that are real assets that have more of a stable value over time. And multifamily is one of those assets. Interestingly, if you look back at previous recessions, you'll see that Class A multifamily cap rates, even though there's a worry that they could increase, multifamily cap rates for institutional level assets actually tend to decrease during deep recessions or time of economic volatility, exactly because of this phenomenon of looking for a safe asset versus something that's a little more volatile like the stock market, or in this case, a lot more volatile. The other thing to compare is, generally speaking, when you look at commercial real estate values, multifamily cap rates tend to be the lowest across commercial real estate. And the chart on the right shows you that office, industrial, and retail cap rates are higher than multifamily cap rates, meaning that values are higher and cap rates are lower for multifamily. And one of the reasons is because multifamily rents have the ability to modify leases every year to keep up with changes in expenses, in debt service, et cetera, where oftentimes office, industrial, or retail have longer leases that may have a harder time adjusting with the economy. And so not only is multifamily a great asset to invest in during good times, but it's also pretty competitive when you look at other alternatives, especially heading into recessionary economies. Next slide, Jeff. Okay, so I want to also talk to you about, did we go too far?
No.
Okay, about multifamily tax benefits. And I'm going to turn this over to Merrill to talk to you about that.
Hey, everybody. I jumped the gun when Anna wasn't finished talking. Sorry, Anna. So yeah, we're talking about why multifamily is a good investment. And then here's some of you may or may not know about the development side, but most of you are very aware that there's always accelerated bonus depreciation. I shouldn't say always. There is accelerated bonus depreciation that's associated with existing assets. Last year was the last year where if you were able to apply it, you could get up to 100% bonus depreciation for an asset that closed in 2022. Little side note, we closed an asset, I think it was at 3:20 p.m. on December 31st of 2022. Lender was playing little games with us at the very last second. So that was a squeaker, but we got everybody in on the 100% bonus depreciation. This year, it reduces by 20%. Next year, it reduces by 20% and so on, unless Congress decides to modify or change. But just keep in mind, even an 80% bonus depreciation is very helpful. And if you can apply it, and even if you are able to use it, but you have nothing to use it against, you can bank that and use that later. So one of the things many of you may know that Revision Masters is very bullish on new development, especially with the economy we're in now, because it potentially positions ourselves to have some really nice assets available and online as we're coming out of the recession. But there's some benefits aside from just your typical build it, lease it up, stabilize it, and either sell it, depending on a good cap rate, or recapitalizing, giving investors their capital back, and then having a nice cash flowing asset. So there are tax credits and tax deductions that are available to all new construction or most new construction multifamily. These are primarily geared towards garden style, 3 to 4 story walk up. So there's 45L. Again, I'm not a CPA. I'm not providing tax advice. This is a blurb of very long statutes that were recently put into effect. But the 45L tax credit gives you up to $5,000 per unit, and that's as that unit is leased. And that $5,000 is determined on the energy efficiency of that actual unit or the building and labor rates. So the labor rates are not the labor rates of the tenant, they're the labor rates of the workers and construction that was utilized in order to build out this unit. So the federal government has just literally released about 2 or 3 weeks ago, maybe 3.5 weeks ago, kind of the minimum labor rates that you need to be at in order to qualify for a portion of the $5,000 per unit. And we can provide you some information later for those that have interest. But $5,000 tax credit, again, not a deduction, that's a dollar for dollar tax credit. So it's about 2.5 to 3 times better than a deduction, depending on which tax bracket you're in. And so if you're building a 400 unit multifamily, that's $2 million in tax credits that can be spread out amongst the entity. So that's equivalent to almost a $7 to $8 million tax deduction. And on top of that, these are not exclusive. You can also qualify for a 179D tax deduction, and essentially they're the same requirements. It's based on energy efficiency and labor rates. And energy efficiency is not nearly as complicated or as difficult as you think. In our opinion, the government has kind of put a fairly achievable bar. If you're building in Texas and you're building A class, you're probably 95% of the way there. Obviously, you need to work with your GC and or owner's rep, and you have to do a study to verify that you're meeting those requirements. But this is based on square foot air conditioned. So same idea. Let's say your average square foot on a new build is 900 square feet. And let's say you qualify for all of this. So you would have up to $4,500 per unit once it becomes online and leased. So you could get in a perfect world. I don't know if we're going to get these high of numbers on our deals. We haven't had studies done, but you could get $5,000 tax credit per unit and maximum, and up to $4,500 tax deduction per unit per square foot. But when you multiply it by 900 square feet, that's per unit. So 4,500 deduction, 5,000 credit. Those are significant numbers. That probably is closer to a $20,000 tax deduction if you combine the two per unit. So there's some very strong incentives that have been put together by the government to encourage all of us on here to develop multifamily, develop B2R, primarily anything affecting housing, though these are not necessarily available to high rises. There are portions of these that are. Let's see, John, would you grab the next slide?
Yeah, before I jump into this extremely busy slide, I just wanted to also quickly mention that we had over 500 people sign up for this webinar. So we're extremely humbled and thankful for all of you, again, whether that's live or we'll be listening to this recording for signing up and participating. And on top of that, of the 500, we had 100 folks that weren't in our ecosystem or in our community previously. They were new to Revision Masters, and so we're welcoming those new folks to, again, either join us live or listen to the recording as well. So I appreciate that. I'm going to jump over. We were talking really more about why multifamily in general. I'm going to talk about why multifamily development. And when I say development, that's ground up construction. So we're taking we're taking projects from dirt all the way through entitlements, through building, stabilizing, and getting an A-class property leased up. And we're extremely bullish on that. We'll talk about that more later. So, but basically, in a nutshell, why did we kind of pivot and get into new construction about 5 or 6 years ago? The primary reason is because there used to be a huge spread in cap rates or in values between A class, B class, and C class, and then ultimately new construction. So you'll see that spread of 625 basis points back in 2011, 2012, and that has slowly compressed over time to where the spread between new development and all the way up to a C class property is really kind of narrowed. And so basically all that means in a nutshell is, in many instances, even though there has been increases in labor and materials, although we've seen a huge drop off in material costs over the last year, even though that we have seen increases in lumber and in concrete, et cetera, over the last several years, the spread or the pricing between buying a C-class property, for example, versus new development up until a few years ago was very comparable. And so we asked ourselves, well, we can buy a 1970s C-class property, or we can pretty much comparably build one for almost the same pricing. And so that's really why one of the many reasons why we like new development is because we're actually, taking a piece of property that's just typically just dirt, ag zoned in many instances, and we're doing all that value add into the dirt, and then ultimately building a brand new A-class property that can be sold at comparable, if not higher prices once the property is stabilized. So with that, I'm going to hand it back over to Merrill, I think.
Thanks, John. I might also add that as we're going through these new development projects that we're all working on, and we're constantly being asked to provide sales comps to various lenders or private equity or family offices, while we are in the great state of Texas, the great state of Texas has a non-disclosure rule, so many of the sales are not disclosed. However, even today, I was looking at some sales from last year in a particular market, and it's still funny to look at when C-class, this was in Austin, I would call it C+, is going at, and they give you the cap rates, was going at a 3.95% cap in November, and their A-class in a much better part of Austin with much higher rents that were being built and had just been sold at stabilization at the same price. And I know what it costs to build. So bottom line is, some of these were selling at, these C-class were selling at 200, C+, 200, 220, 225 a door. And some of these A-class were being built at 230, 245 a door, but garnering 30 to 50 cents more per square foot. So there really is a convergence. So anyway, thanks, John. This is just a cool infographic. Many of you have seen it on our slides. And for those of you that are not familiar with us, of course, we're pro-Texas. We live in Texas, but I would imagine 90% of the people on the webinar right now that invest in real estate probably have some sort of real estate investment in Texas. So just high level, we could give you thousands and thousands of these, because John and I and Anna are always looking at updated infographics. But believe it or not, Texas is the #1 U.S. exporter and has been for 2 decades. Most people don't believe that. Texas is the 9th largest economy in the world. So that's not city, that's compared to countries. So yay, Texas. Lots of airports, lots of seaports. I'm not going to go over every single KPI. As you know, I love KPIs. But if you just have read or do a Google search just over the last 12 months of various companies deciding to either move headquarters here, build semiconductors here, the semiconductor business is you can't even explain it. In the last 2 years, between Samsung, Texas Instruments, Globitech, Apple, Tesla, which just announced they were adding another 6 factories, 5 in Austin and 1 in Houston. It's unbelievable, and we're in I would argue we're in a recession. Probably been one for the last 3 or 4 months. But even if we're not, we're in an economic downturn as a whole. But as we talked about at the beginning, all these numbers that we're seeing with respect to the government producing numbers about where the economy is, where unemployment is, blah blah blah. These are at a very high 200,000 foot level. We can show you places in Dallas, just like everywhere else, where people are unemployed, where rents are decreasing, we're not typically in those areas. You can find those pockets everywhere you go, but generally speaking, and when we talk to clients on the legal side, rents are still increasing. Are they increasing 10 to 20% a year like they were last year? No. But are they increasing? Are you getting lease trade outs at 5 to 9% still? Yes. We're getting them on our own properties. Some of our Austin properties are still getting ridiculous lease trade outs, but you see news that says complete opposite. I rely on facts, not necessarily what other people say. Of course, I'm the one telling you guys this, but we have KPIs that support what we're doing. So anyway, this is just a nice kind of eye candy on, why we're bullish on Texas, why we look at existing and new development in Texas. So Jeff, next slide. So yes, this one isn't as pretty because I actually created this slide myself, and lawyers are not creative. But the credit on this one goes to a book that John suggested I read, and then I posted about it, and a lot of you listening have read it. It's called "The End of the World is Just the Beginning" by Peter Zeihan. And this guy is incredible. He actually speaks like I do. He's a smartass, and has a lot of inflection in his voice, but his knowledge on how countries interact with other countries and how something going on in Morocco affects, a city like Charlotte, things you would never think about. So the book was fascinating. It is one of the longest books I've ever listened to because I didn't read it. The reason I listened to it, I've heard this guy speak a couple times, and he narrates his own podcast and his own Audible. So it's very unique when you have an author that is actually speaking. So you hear his sarcasm to really stress certain things. And so I'm listening to it while I'm at the gym, and I'm lazy. I don't, stop doing what I'm doing if I want to write something down. I just do a screenshot so I can go back and look at the time. And so he talked about Texas, and he's not from Texas, just so we're clear. This guy's not from Texas, but he talked about essentially what we all joke around. Texas is its own country, and we can secede from the United States. We really can't, but everybody outside of Texas thinks we can. It's not really in our Constitution that we can leave the United States. But he put it in a matter of like 3 minutes, what was so special about Texas and why Texas, with all the deglobalization that's going on right now and going to harm many of the other countries, he's very bullish on the United States, but then literally targets Texas as that's the place you want to be in the next 20 years. And so very high level, Texas Triangle. Almost everybody on here has heard of the Texas Triangle. DFW, down to San Antonio, across to Houston, back to DFW. That accounts for almost 22 million of our 29 or 31 million population. And that is where 90% of the growth coming in right now is going in that triangle. Most of it DFW, Houston, and Austin. San Antonio is catching up. So basically it breaks down that Texas Triangle into 3 categories. DFW is essentially the banking hub of the Texas Triangle. DFW basically finances Austin's brain work, which then creates Austin then creates the manufacturing process for what they've come up with. They utilize San Antonio for labor. It's less expensive labor. Yeah, there's, any of us that have invested in San Antonio, just the rent's a little bit lower. The demographics make a little less, but it creates great labor. And they then put it on assembly line, and that is pushed off to Houston. And Houston's kind of the focal point. Everybody who is my age or older has always heard Houston's oil and gas, Houston's oil and gas, Houston's always oil and gas. Then Enron files bankruptcy, and Houston's definitely oil and gas. The whole city, all 6 million people are going, they're going to die because Enron went under. Enron was ugly. I was actually representing a creditor on Enron, a bank, but Houston is incredible. So between these 3, Houston combines Austin's tech, DFW's automotive and banking centers, and San Antonio's mass manufacturing with Houston's hub meaning Houston / Galveston area. And so it's the #1 hub in the US. It's the #1 port in US by value of cargo. Not many people would have thought that Houston has the #1 hub for value of cargo. Now there's more volume that goes through LA, but there's more volume by cargo that goes through Houston. And then they are #2 globally behind Germany. And I don't know if you follow macroeconomics, but Germany has always been #1 when it it comes to manufacturing and metal workmanship. I mean, BMW, Mercedes, all sorts of other machines and appliances. So to have Houston as number 2 behind them is incredible. And then I don't like this, it's number 2 in the US for most Fortune 500 HQs, headquarters. I like to think DFW is, but I looked at the numbers. Houston's 5 more than DFW. So we need to get some of the people on here who are part of Fortune 500 companies to get them to move to DFW so we can beat Houston. Anyway, long story short, this was an excellent graphic and it does not do the book justice. Again, maybe Jeff can put it in the chat, but the book is called The End of the World is Just the Beginning by Peter Zahan. And, the credit goes out to John, who got me to read a book, which I rarely do because I'm a lawyer and I read all the time. And rarely will I read someone else talking about something. This guy is absolutely fascinating. I know Andrew's nodding his head because he's read it, and Jeff's reading it. So anyway, great infographic about Houston, and this is why we are so bullish on Texas. I'm going to leave that with Anna.
Great. Next slide, Jeff. So just to underscore some of the things that Merrill just talked about in terms of why Texas, one of the things that's happening because there is so much opportunity and there are so many companies coming to Texas to start manufacturing operations and financial firms and energy and all types of different R&D and jobs, it attracts a young labor force because these companies are coming into Texas. They have no corporate income tax at a state level, and so it's less expensive to operate in Texas. There are more consumers and more workers and more people of a young labor force than in many other areas. And so if you look at the employment change by metro year over year in the last year, you'll see that Texas cities rank up in the top 10 by and large, bigger than in other states. And so you've got Dallas and Houston and Austin and San Antonio all showing tremendous employment growth in these cities over the last year, and it's just continuing to build. If you look at our posts, John and Merrill and I, we post a lot about all the new jobs that are coming in, new companies opening up every day. Like Merrill said, a lot of them are moving into the DFW area as well as Houston. And if you look at the young adult population change by metro over the last 5 years in the entire country, you'll see that more young adults have moved into or aged up in Austin than in any other major metro in the United States. And Dallas, Houston, and San Antonio are not far behind in terms of percentage change, but DFW and Houston actually had the largest influx of new young adult workers who are also those that are spending and keeping the economy healthy compared to a lot of other areas in the United States. And it's not going to stop. If you look at the population projections over the next 5 years, you'll see that Texas is projected to grow in every single major metro that we talked about in that triangle, with Austin, Dallas, Houston, and San Antonio all having significant population growth, specifically in that young labor force and young consumer force age groups. Where if you look at the United States, it looks like we're going to have less young adult workers throughout the country. They're all coming to Texas, or at least a lot of them. Next slide, Jeff.
Hold on real quick, Anna. I just want to point out one thing. So when we talk about where we invest and where we build only in the Texas Triangle, but there's one other market that John mentioned very briefly at the beginning that we do buy existing multifamily in, and it's a market that's on both of these charts. It's Charlotte. Raleigh. Right? Buying the Raleigh area. It's not on these. It's in the top 20 on both of these. But when you look at the top 20 charts on both of these KPIs, there are a lot of clients that are buying in all of these cities that are up here. So we're bullish on Texas, but most of these other markets are very strong markets too, as the numbers support. Again, it's hard to get around KPIs and facts. The media may say one thing, or reports may come out from the government saying this city is slumping, but at the end of the day, you follow these numbers. These are markets that you want to be in, and then also follow where the companies are going. They're spending way more money in research than we are, and have way more economists than us just having John Monteiro. So they really know where, I got a smile, they really know where the markets are turning to. Go ahead, Anna.
Absolutely. Okay, sure. Next slide. So another point that just underscores the lack of supply relative to the demand is that if you look at Austin, Dallas, Houston, and San Antonio, you'll see, as John alluded to earlier, that housing affordability has become significantly higher than what it was before. And so a mortgage payment versus the effective average rent of an apartment complex in Austin is $2,800 a month difference. It's huge at this point. Looking at Dallas Fort Worth, it's doubled. The gap over the last 3 years between owning a home and renting that same home is now $1,600 a month. In Houston, it's a little over $1,400 a month, again, more than double. And in San Antonio, it's just more than doubled in the last 3 years, with the gap now being $1,400 a month, almost $1,500 a month between the rent and the cost to own a home. And so that, we believe, is going to continue, maybe not quite the same spread over time, but as the Fed raises rates and as more people move into Texas and there's still limited supply for those people moving in, those rent gaps are likely to stay pretty large over the next couple of years. Next slide. And one other thing I thought I would just show you specific to Dallas. So again, I'm from Houston, so I'm going to be, Team Houston, where Merrill over here is Team Dallas in terms of where we want the most prosperity or what city we like best. The reality is everything is better in Texas, right? Spoken from a true Texan, but based on the data and based on the KPIs. And one of the things that I really like about the Dallas-Fort Worth area is that cities in Texas tend to be more conservative and more pro-growth. And so Dallas in particular has a Resilient Dallas initiative that they developed in 2018, designed to make the city more resilient to economic shocks, to natural disasters, and any other type of stressors like poverty, housing shortages, et cetera. And they incentivize, by and large, companies to come, people to come and live and work. So they have really done a lot to try to draw people in. And what you can see is it's really evident in the numbers. If you look from 2018 to November of 2022, you can see that the year-over-year change in employment in the DFW area is much higher than it actually is nationwide. And not only is it higher employment, but many of those jobs are coming at higher dollar value wage jobs. And so you'll see a growth of 50,000 professional and business service jobs, almost 50,000 in leisure and hospitality, but other high paying jobs in education and health services, utilities, transportation, financial markets, manufacturing, etc. And it just goes without saying, but it underscores the fact that Texas really is pro-growth, pro-business, pro-job, pro-jobs and pro-economic prosperity. And while some cities are pushing people away, raising taxes, not tackling homeless situations, and really pushing corporations out because of the corporate taxes, Texas is saying, welcome to Texas, come on in. We want to maintain resilience and economic resilience. And because of that, even if the economy nationwide struggles over the next couple of years, we know that Texas is the place that's really fighting to stay resilient and doing all the things to keep our jobs and our wages and housing affordability where they need to be to continue to thrive long term. And with that, I'll turn it back over to Merrill.
So Anna, you're basically telling everybody that Texas will be the reason that the Feds continue to raise interest rates, because wages are going up in Texas and unemployment is going down. So now everybody listening is going to not like us, right? Is that what you're saying?
No, that's not what I'm saying.
Just kidding. All right, let's get to the fun stuff, Jeff. Okay, so what we said we were going to talk about, and we'll spend a few minutes on it. And John, I'd unmute yourself because you and I have lived this, the next two slides. But this is just a high level of where we're looking at multifamily development projects. Right? These are actually projects we have. Believe it or not, there are a couple on here that we have recently picked up that aren't on this chart. This chart's about 2 months old. But where we target new development should be the same basic areas, if you're looking in Texas, that you should be targeting new development. We try to stay right now in this economic environment in the core cities. We're not bullish on San Antonio right now for new development, although we could be talked into it with the right demographics. But as you can see, we basically look at, not even basically, all of our areas are path of progress areas. So we take north of Dallas, excuse me. So kind of Frisco all the way up to Sherman, 1, 2, 3, 4. And those are the areas where people are moving to, where companies are putting either headquarters or $30–40 billion worth of semiconductors. And then we also like to focus on north and west of Houston. So anything kind of Spring and up, Spring, Texas and up, all the way over to Katy, and even as far over as Conroe. Conroe goes west as well. So we like those areas. That seems to be where all the demographics are going, the new jobs are going. Matter of fact, Tesla's new manufacturer plant that they just announced is going up there. And another thing you have to think about when you're doing new development, any of you that are sponsors on properties in Houston, one of the biggest issues we have in Houston as far as expenses is insurance. Insurance is very expensive in Houston because when you look at the news, the media shows one place, obscure place in Houston that's flooding, and they say all of Houston is flooding. Now, Houston does have some floods, but all of Houston has never flooded. We had 714 homes during Harvey, and we had 7 homes that actually flooded out of 714. However, you look at the media, all of Houston was underwater. Jeff actually drove with me down there in a Jeep, and all of Houston was not underwater. There were parts, but not nearly all of it, small percent. But so we look at north and west, and then we love Austin. Everybody loves Austin. Austin is expensive to build and very time consuming. We're not going to go into details because I saw a couple of our partners are on here already. They can attest for the time that you have to spend to go in Austin. One of the other things that, and again, this is not secret sauce. There is so much opportunity out there. You guys are not competitors of ours. Part of this reason is to help educate. We look for ETJs. John, what's an ETJ?
Extraterritorial jurisdiction. It's basically land outside of the city limits.
Why is that appealing to us?
Less restrictions, less regulations. We still obviously have to build to code, but we can typically move through the entitlement process relatively quickly compared to dealing with some cities.
Yeah, and so like typically in most cities, if you're doing garden style, getting zoned for garden style, your height limit is 40–45 feet. So that's 3 stories. If you want to push it, you can go to 4 stories with a flat roof. Then when you go to 4 stories and you're in the city, you have to put an elevator, at least one per building. Elevators will run you 120 to 150 grand, depending on what you're putting in. When you go to ETJs, like our Austin project with our partners, there is no height restriction in the ETJ. So, and that ETJ literally could be 500 feet from the city of Austin. And the average person has no idea they just stepped out of technically Austin. Now they're in the ETJ, extraterritorial jurisdiction. So when you're that close, unfortunately, like on that project, you have some regulations from Austin, you have some regulations from Travis County. And what we've learned is Travis County likes the environment the same, if not more, as Austin does. So those take longer. So when you're picking projects like we do, you look at the demographics, where's the job growth, what is the average wage? The average wage is very important. Always look at median incomes, but look at median incomes if you can, that only go out 3 to 5 miles at max. And then when you look at the median income, it's really simple. If your median income is $60,000 a year, divide that by 12, that's $5,000 a month. Divide that by 3, that's the rent that you need to be shooting for. If your rent is more, that's like $1,666 a month. If your average rent's going to be $2 grand a month, because you're building this incredible A-class, A++, you're building in the wrong area. You're building above your market. And so that's something you don't want to do. So you still go back to your basics that you are with existing. You look and see, you want to build to what is either coming or what is already there. If you build above it, you're not going to have any occupancy. You're going to have issues. And then you can just see our average build, what we have found, especially as prices have come up a little bit. Lumber's come way down. And when we say lumber's down, John and I just worked with our owner's rep on a project we have, and we shaved about $6.5 million off the construction price. Half of that was lumber, because lumber was priced at about 8 to 10 months ago was the price, and today it's that big of a difference. So some of the pricing's come down as home builders are letting off the gas pedal. Some put the brakes on. There are more and more companies reaching out because they need their workers to be employed. And so as you see that, hopefully that's part of the wages coming down. I haven't seen the wages coming down. We just see more availability. But the fact that there's more availability means projects will move along quicker, which means our cost on our debt is not as expensive because we move things faster. And so time is always equal to money. Let's go to the next slide. So that's our new development. Okay, so we have this link, and Jeff can put the link in the if he can find it, can put the link to this. So we actually created something on our new website. You guys are welcome to look at it. Revision Masters, www.revisionmasters.us. So it talks more about what we do, blah blah blah. But we have a link because we're very big on well, we don't buy anything on market. We try not to buy anything on market. We're only looking for off market. And people bring us opportunities, sometimes want to JV or partner with us. And so we're very big on encouraging people to, if they have something, let's say they don't know how to build the capital stack, or they're new to it, but they found a great opportunity, or they don't know what to do with an opportunity and it fits within these parameters, we will look at it. We'll meet amongst ourselves and decide what's the best use. And if it's a good fit, we may either buy it, or we may JV it, or we may say, no, thank you, but here's some other people that have the bandwidth or that like that particular area. And so when it comes to multifamily, we've been pretty consistent, other than we're just trying to stick in these major areas right now while there's the economic uncertainty. But 1985 or newer construction, these are you know, they fall within 80% of what we're looking for, because I've got it. We know we have investors on here that know we've bought some late 60s and early 70s assets in Austin. There are always outliers that make sense, but generally speaking, we don't look at anything under 1985 construction. 250 units or larger, scale always seems to trump versus smaller units, though you can make money off smaller units. Our comfort zone is 250 or larger. DFW, Houston, Austin, and Raleigh. Those of you that know us, why Raleigh? That doesn't make sense. Raleigh looks just like Austin. Maybe not quite as weird as Austin, but demographics, economics, job growth, companies moving into that area, the Research Triangle. Raleigh positioned itself just like Austin, and Raleigh is doing very, very well on lease trade outs on our assets there. So we're very excited about that. And then I talked about 54K plus or minus, it says plus median income, because that's basically going to be about $1,500 a month. If you're assuming that the average renter is spending a third of their income on rent. And so typically your B plus, your B plus, A minus, you can fall within that range. We don't look at anything that has less than a 54K median income or per month, per year in a 3 to 5 mile radius of our targeted asset, because we know it's just, you're not going to get the rents. People are not going to move from a higher median income area to a lower median income area to pay $100 less in rent. It just doesn't happen. And then 2.7% plus targeted growth within 5 mile radius. Now that doesn't mean everybody else. We try not to buy in areas where the growth is not increasing. Okay. We want to be in areas where growth is increasing within 5 miles. So more people are coming in. What does that do? It creates more demand. Now, with that said, we're also going to look on CoStar or one of the other sites to see what new development projects are in the pipeline. So if we're in an area where it's got 2.7% growth, but it looks like they're going to be 5% of the population in that area of new products, that's a no for us. Okay, we're not going to compete with 1985 build when John Monteiro is building an A plus that's coming online next week, and his rents may be only a couple $100 more, but so much nicer. That's the exact reason why we like new development, but we do it in new areas, not existing areas. And then value add. Everybody talks about value add, value add, value add. Value add is a couple things. It's a good operator hit their business model, decided not to add CapEx. They've already hit their business model, didn't raise rents, creates a lot of value add for the next people. And yes, those are out there. And yes, those are out there at good pricing. The issue is finding financing and capital. Those are out there, and pricing is coming down on value add. It never really went up. The issue is building the capital stack for that. The other thing that we like is there are many of these value add opportunities, 1985 or newer, that are mom and pop managed. And they did what they needed to do, but they may have 30 or 40 month-to-month leases in a 300 unit complex. And so they may be generating $700 or $800 a month when market rate is $1,500. We don't go into a deal to try to beat market rate. We never go into a deal to try to beat market rate. We're not trying to set a new market rate. We're trying to enhance the property so that we can get market rate. If it's already at market rate, it's not a value add proposition, and we're not going to go for it. On the new development side, kind of went over it earlier, path of progress markets. And we get pretty detailed here. So, you can try to go after some of these assets too, these land deals. But Denton, if you're looking in North Texas, Denton, Prosper, Salina, you're not going to get any multifamily in Salina right now. So you would have to buy land that's already entitled multifamily. You need to really make sure it's entitled multifamily, because the city is not approving new multifamily. McKinney, again, just about the same thing. Anna, Princeton, Sherman, we love. We have 1,700 units entitled up there. Then go down into Houston, Katy, Spring, Woodlands, Conroe, and then we like South and East Austin, as John mentioned earlier. It's very competitive in South and East Austin, but there's an enormous amount of growth, so interesting opportunities. And then on new development, we have found from our experience, anything less than 14 acres doesn't make sense for us. And it's not that we're trying to get the most acreage possible. Cities typically have a maximum density requirement of X amount of units per acre. And so typically you can get either the city allows, or you can get a variance up to 20 units per acre in most areas. Check with your architect and your engineering before going hard on a contract. But that gets you 280 units. And then also, if you're looking at land, be very, very careful. Lots of big parcels out there, and they look great. All you got to do is look them up on FEMA. Look at the FEMA map. If you see a huge flood zone that covers, more than 5% of the property, you need to talk to somebody and find out, is it still worth doing the deal? John's a huge fan of flood zones, so he takes properties out of flood zones all the time. But you can remove the property out of the flood zone. It costs some money, and it can take a lot of time. We've got two. One is out of the flood zone, and one is coming out of the flood zone. But you're at the mercy of FEMA. FEMA is a governmental bureaucracy, and FEMA gets you the letter of approval when FEMA decides to get you letter of approval. And then on new development, as you can see, we look for a higher median income. We're not building a new apartment complex or a new multifamily to generate the same rent as a B class. In these emerging markets or path of progress markets, that is where a lot of the higher paying jobs are going. And that's where families are moving to from either out of state or from urban to suburban. So we are looking for median incomes that are in that area. So the reason we go over these real quick is we welcome anybody on here to bring these opportunities to. We love partnering. We love buying, presuming they make a lot of sense. And yeah, you've got to go through the very stringent process of meeting all of our spouses before you can partner with us. That's much worse than getting a loan through a bank right now. But we have this thing where John says it's the best. I'm not going to say it right, but what is it? Similar.
Aligned values with complementary skill sets.
Yes, aligned values with complementary skill sets. And when you're looking at John and myself and Anna, values don't have to be that high. You just have to be able to smile and talk to people. But all kidding aside, we welcome opportunities, and we do have people sending us stuff. But we created this site, and I think Jeff has posted the link. I just haven't looked at my chat box. But we created the site so you can easily upload something. It just goes to the three of us, and we'll look at it very quickly, and we'll tell you yay or nay but it won't just be yay, it won't be nay. We'll say no, this is why we're saying no. Not that it's a bad deal, but we're saying no, hey, come back and bring us something that fits our parameter. And it may not be right for us, but we may know others that are very interested in that, and we're happy to facilitate that. Jeff, do I have another slide? Yeah, next slide. And this is just an example of, I think this is our Princeton project. Again, we talked about this before. Just an upcoming project that we've got in Princeton, 480 units. We're very excited. Princeton's a path of progress market. We've got quite a few actually getting close to breaking ground for at the same time. Jeff, next slide. And then kind of just to kind of recap or tell you guys kind of what we're doing. We're very big in value add, very big in multifamily development. Our core has always been value add. We're leaning obviously more towards development as the economy changes. But one of the things we want to talk about on the next month's webinar, and I'm sure I'll post before then, about our financing escapades that we go through on I like to say daily, but pretty much hourly basis. But real quick, we're just talking about kind of building your capital stack. And, if we can help you guys go in the right direction, that works great for everybody. But you got bridge to perm, you got agency, you've got banks, you've got private equity, family offices, syndication, and LP partners. That's all on the multifamily side. And those same can be on the on the development side. But on the development side, and a lot of this is some of this is John's creations. You have A&D loans, you have horizontal loans, you have vertical loans, senior lenders. That doesn't mean old lenders. That just means they're first in line. You have private equity, you have family offices, and family offices, not Merrill and Kim's office wanting to loan money. These are very, very high net worth offices. They're not always the least expensive, and sometimes least expensive, most expensive may be the easiest money. So you got to weigh all these different factors in on why are you using this particular equity or capital stack? Is it easier? Is it more efficient? Do you have too many projects at the same time, or you pass and use something else? And then we'll have a whole discussion on PACE and CPACE. Many of you have never heard of PACE and CPACE. It's another type of lender that sits on top of the senior, but actually is senior to the senior. Another discussion. And I think the last slide, Jeff, is Q&A. That's actually not Photoshop, believe it or not. That's an actual real shot, and that's our Princeton property. So you're going to see the background is eventually going to look like 480 units, and there's the Princeton water tower behind us. So I'm going to turn it on for Anna and John, and I don't know if Bernard is still on or not. I was going to introduce Bernard right before we end. Bernard is attending, but he might have stepped out for a moment. But we did bring another person on board, Bernard Kaliser, and he is our chief investment officer, and he comes from the banking world as well, and is helping us build part of our capital stacks with funds and credit unions. So very excited. And then we also have Andrew Lee, who did not fall asleep, which is very good. Helps us take care of all of our existing assets, which is a whole other issue. So I'm going to go through real quick and look at questions, and I will ask John and Anna to answer the questions because I can't talk much anymore. Let's see.
Jeff, you want to turn the slide off so we can have?
Yeah, so we can see faces. So, oh, it's so funny. This is not a question, but I just thought I'd have fun. I'm not going to call out names because that embarrasses people. Someone said to me personally, I'd like to talk you into San Antonio for multifamily development. Something about strong demographics are here, Merrill. Again, you can talk us into anything that makes economic sense. Does that make sense? So if you have a development opportunity in San Antonio, didn't say we wouldn't do it, but there's only 2 or 3 spots where we would actually develop in San Antonio. And I would recommend you talk to Anna first.
Northwest.
Well, yeah, but even Northwest, very specific. Northwest, right. And then like the Shirts area, if it's close to the 35, and they're funny. Plus, we don't have hurricanes like Houston. No, but San Antonio has flooding like Houston. let's see, Trump will bring back, I don't want to talk about that. Let's see. Bill, you need to text me. You're entertaining. Can you cover risk of new development, multifamily versus existing multifamily? John? So this is a canned discussion. This is a canned question. John's favorite topic is talk about.
Who asked that question? It's like
Harish is laughing. He's smiling. So Harish Yar, you can unmute. I don't know if you can unmute, Jeff. Harish asks, I don't mean to call you out because he's smiling. He's like, can you cover risk of new development, multifamily versus existing multifamily? John, please tell everybody your 4 risk buckets because I've heard it a million times.
Maybe we'll pull up that slide at a future presentation. Look, the first initial gut instinct that people have when that have not done new development before and they hear about new development, they say, oh, that's extremely risky. And look, at the end of the day, it's all about knowledge. It's all about the team that you surround yourself with, and it's all about execution and how you de-risk any deal, whether you're buying a B-class apartment or you're building something from the ground up. So we have this methodology that we use on every single one of our land deals, and those are 4 risk buckets. And in order for us to get comfortable to do the deal, we have to be able to check the box on all 4 risk buckets before we move forward. So very simply and very quickly, the 4 risk buckets are, number 1 is entitlement risk. Entitlement risk is basically, in my mind, the riskiest part of the development process. It's where you take existing land and getting it through entitlements, whether it's with the city or the county, and having permits so that we can actually build what we think we want to build. I've seen many instances where folks will buy land with investor money and bank money and then go and try to get that land entitled. And city council will basically say, oh, that's a really nice plan, but we're not doing any more multifamily here. And now all of a sudden you're in trouble with your investors and with the lender, because what you thought you were going to do with that land, the authorities aren't allowing you to do that. So we want to get through entitlements, understand what that process is, and de-risk it as much as possible before we move to the second risk bucket, which is the capital stack. So the capital stack is now you've got entitlements or permits in hand. Now we got to go out to the market, whether it's debt and or equity, and get this project capitalized. And so in today's market, that's it's been challenging, to say the least. As Merrill has said several times, a year or 2 ago, I'd make a couple phone calls to my relationship lenders, and they say, yep, let's do the deal, and that would be it. Now we've got to do a little bit more phone calls, shaking the trees, having a lot more conversations, because the banks are a little bit nervous as what's going on. We think that's going to settle towards the back half of the year, but that's the second risk bucket. If you can it's great that you can get permits in hand, but if you can't actually get the money to build it, then you just got expensive dirt. The third one is execution risk. So once you have your capital stack lined up, it's all about executing. It's all about building two things: on time and on budget. That's it. So you've got to have the right GC in place, the right contract with the GC, the terms in the GC contract. We've got to have owners reps and project management on site to make sure that things are happening on time and on budget. And then finally, the last risk bucket is exit risk or refinance risk. That's basically, you're now 4 years into the project. You've got a beautiful building. It's leased up. And what do we think that market is going to look like in 3 to 4 years to either refinance or to sell? And nobody knows. Nobody has a crystal ball, but we feel like we are building in markets that are already seeing growth. And by the time that we actually deliver the new product to the market, all that growth will have caught up into that path of progress market for a successful exit or refinance. So that's a long-winded way of de-risking our development project as much as possible.
Harish, is that good for you? He's not going to ask that question. So another question, this is simple, I can answer this. Do the passive investors share in multifamily tax benefits and deductions mentioned? Absolutely. Okay, absolutely. That's not necessarily a GP thing. That's the entire fund. Let's see. How does the increased interest rate, has the increase for interest rate had an impact on new construction? Do you have fixed or floating mortgages for new construction? That's interesting. So we have a unique deal on one project. Same lender gave us a term sheet for the land and a different term sheet for the horizontal development. We were just looking for an A&D loan, which we'll talk about on the next webinar. But an A&D loan is you want the lender to simply finance a portion of the purchase of the land and a purchase of the horizontal, all the infrastructure that goes before you go vertical. And very unique. One was a fixed rate, which was the land, and I believe, John, I think the horizontal was floating. And so that answer to that question is the lawyer answer. That's why I'm answering the question. The answer is it depends. We're seeing most banks and bridge going floating. Most are. There are a few that are still fixed rate, and even if they're giving you a term sheet, doesn't mean they're necessarily going to close on it. But the term sheets we see and the discussions we have, most are floating. They're either SOFR plus, I didn't want to do this online, but SOFR plus 350 all the way up to 950. And so just so we're clear and people understand that, SOFR is the current Fed rate. It's either 4.75 or 5, depending on which term you're looking at. And then when I say plus 350 or plus 950, those are basis points. 100 basis points equals 1%. So if we say plus 350, that's plus 3.5%. If we say plus 950, that's plus 9.5%. And yes, we have been quoted terms at SOFR plus 950. And they want a personal guarantee, and they want 1 year's worth of interest reserve, and they're only loaning 60%. So they are all over the board. So John was very polite. I'm not as polite when I talk about some lenders where you have to talk to a lot of people in confidence. In our circle, John calls it kissing a lot of frogs. And one of them maybe will be a prince. So anyway, I hope that answers that question. Let's see. Someone likes my flag in the background. Awesome. How about Crosby, Texas? Anna, would we look at Crosby, Texas?
Probably not at this point. It's too small. There's not enough growth, enough high value jobs and wages at this point.
Yes. So and I know this person. Got quite a few comments from this person. The response, the one at Crosby, Texas, they are putting a large highway to attract retail. That's awesome. When that highway's in, then we'll look at Crosby, Texas.
Just a quick caveat there. John mentioned, we want to get in these path of progress markets when there's already quite a bit of progress and where we expect that progress is really going to catch up with the lack of supply within about 3 years. And so we don't want to build something unless we think that the demographics and the population are going to support filling that complex when we're done developing.
Right. Oh, and real quick, everybody. So Bernard has actually shown his face, and I'm going to call him out. So Bernard, just wave so people, those that can see you, can see you. Just wave at the camera.
Hi, everybody.
Bernard's our foreign correspondent from Canada, eh? And this literally is the epitome of what we do. So he's coming in as our CIO, and he is migrating from Canada to DFW. Okay. So he will be the person next time that talks about everybody's moving to DFW, because he is picking up his pregnant wife and child and moving them and building a house here in DFW. So we figured anybody that's actually moving their entire life to come to become a Texan, got to come work with us. So anyway, good guy. We're very excited to have him on board. And look, Anna can't stop smiling.
Thank you, Merrill, for the compliment.
You're welcome. So, and it says, when bringing your deals, where can I look to determine median income with a 3 to 5 mile radius? I might ask Jeff, who's looking at his text messages right now. I might ask Jeff if there's an easy site for them to look at. Otherwise, I would say go to CoStar. Jeff, do you have a quick and dirty of where someone can kind of figure out what the median income is if they put in an area or an address?
Yes, there are some search tools on the census, US Census website. If you want to look at zip code, tract, city, what have you.
Yeah. So if you want to send us an email at info@revisionmasters.us, Jeff can probably send you a couple links.
Yeah, please do.
To that. Yeah, good question. And look, if you don't know the median income in that area, if you put the city or the intersection, one of the three of us will pretty much know without having to look it up if that fits our requirements. Let's see. How do you decide on unit mix? We do not recreate the wheel, people. We do not recreate the wheel. Our typical unit mix, and John and Anna, you can correct me if I'm wrong, is typically going to be on new development about 45 to 55% 1-1s, 40 to 45% 2-1, 2-1s or 2-2s, and then 5 to 10% 3 bedrooms. It's not that we don't like 3 bedrooms. You're competing with B2R, built to rent. And so when someone's looking at a 3 bedroom, 2 bath, 1,200 square foot apartment, or they could pay 150, 200 bucks more a month to have a 3 bedroom, 2 bath, house with a yard and a garage, they're going to go with that. So typically we do that. The question, would you guys ever look at B2R development? John, you want to answer that?
We're always looking for new opportunities. Our bread and butter is garden style 3-4 story apartments. However, BTR, for those that don't know, is built to rent. They call them, horizontal apartments. So they're one level. They're either townhome style or small single family home styles in one community, in one area, with a leasing office and amenities, just like an apartment. The primary difference between the two, as Merrill mentioned, is a little bit more expensive to rent, probably a little bit more geared towards families and pet owners. And just from an economics and financial standpoint, because we're not building up and it's just all one level, the density for built to rent is typically less than apartments. And so when you've got less density, you've got to make it up in the financials somewhere. And that's either going to be in the cost of the land, or it's going to be in the increase in the rents. So if the numbers work, we are always looking for new opportunities, including built to rent.
And real quick, not that we have looked or researched built to rent, but I'm pretty sure that the average dollar per square foot in the same areas, where we may be at $1.82 to $1.87 for multifamily, is $210 to $217 a square foot for B2 rent, B2R. And so, yeah, we actually have one or two irons in the fire on that. But yeah, by far our bread and butter is multifamily. But again, you need to focus on trends. And when you see the developers on single family slowing down, and the demand is still there because people can't afford to buy a new home at 6 or 7 or 8% interest, but they need a home. Well, now you potentially have a build to rent that's going to be less than the mortgage. They don't have to put a 10 or 5 or 10 or whatever the deposit is down, and it's a good opportunity. But again, you got to be very selective where you're going. Someone asked, can we just fund ourselves? Someone asked, John, do we do new development in Charlotte?
Currently, no.
Why not?
We like that. We like that market. We would probably, if the right opportunity came up, buy in that market. But what we have found, or at least our thesis is, we want to actually be boots on the ground in our backyard for all of our new development projects. There's just so many moving parts, especially once you start building, that I would prefer to be able to get in my truck and drive to the site versus book a plane. So that is really the only primary reason why we don't build out of state, at least currently. We've got our team here locally. We know these markets extremely well, and we can get to these projects on a daily basis as needed.
So I want to spend like maybe the last minute or two. Jeff, can you unmute Bernard? Sorry, Bernard, I'm going to put you on the spot here. This is Bernard's first time to do a webinar with us. Bernard, look, I think it would be informational, if not entertaining. Why did you and your wife decide to move to Dallas?
Well, terrific point there, Merrill. The primary reason being is when you look at North America and predominantly Canada and the US, the Texas market is probably, if not the top market to do multifamily. And whether that's existing or development. Up here in Toronto, we've been doing a lot of condo for sale. So this is probably the riskiest type of development you can have, because you're building with concrete, you're building mid-rise, high-rise, and the types of returns on a risk-adjusted basis are comparable, but even lesser to what you get on a multifamily garden-style development in Texas. So, and you can do more of these projects. The time to entitlement, planning, zoning, site plan approval, it's out of our hands as developers. It's something in the city's hands and the county's hands. That's why it's kind of the riskiest component. The time to entitlement and planning is the quickest, you can kind of say, in Texas. Some different jurisdictions, 4 to 5 years just to get a piece of urban or suburban type of lot, get its zoned, site plan approved. So the primary reason why we're moving down is just you can do a lot of these deals. The risk adjusted returns on these deals are far exceeding any state in the US and any even province in Canada. So, you know, it's primarily driven by me. My wife's very supportive of the move, but I believe it's going to continue not only for the next 5, 10, but in the very long term.
Bernard, that was like the canned answer. I wanted you to say the taxes in Texas are better than the taxes in Toronto.
That, as an accountant, I can attest that yes, the taxes, both on a personal income level and also on an investment type level, not on a property tax level, mind you, but on a total all-in tax bill, much better in Texas than anywhere else, pretty much.
Is the cost of living in DFW the same as the cost of living in Toronto?
It's less. So that's in terms from an affordability factor to a from a tax point factor, yeah, it checks all the boxes.
I apologize.
You don't know it yet, but the people in Texas are really, really great. So you'll love raising kids there.
Yeah, and the people are less expensive. It's awesome. But yeah, for those of you that don't know, I used to be a corporate bankruptcy litigator, and so I go into deposition mode, and I didn't tell Bernard that I was even going to bring him on camera. So I would have said, hey, Bernard, everybody knows why you should invest in Texas. Tell people why you want to live there, because you could do the investing from somewhere else, but you chose to move your family and have a new child who won't be born here, but might as well have been born here in Texas. And so I know you have a very loving wife, but you had to convince your wife, hey, there's something special about Texas.
Yeah, no, I not a lot of convincing, to be honest. She was very supportive from the start. She loved when we visited there many times prior. So it's a win-win for us, both on the professional and personal level.
And we have a hockey team, so you'll be happy.
Sure.
He doesn't like the Stars. He doesn't like the Stars. Listen, I don't see any more questions. You guys are welcome to ask us questions, and we really encourage you guys, if you see opportunities, even if you don't want us to be part of the opportunity, you are more than welcome to shoot us an email and ask us what we think, especially me or Anna. John doesn't get as excited about responding to people on those types of things, but we're constantly focused on the underwriting too. So happy to just give our opinion, but 2 things. 1, opinions are like rear ends. Everybody has one. And 2, you're not paying for the opinion, so you get what you pay for. I guess in 3, Anna will be much nicer about it. I might be possibly a little more direct on what I think about the asset. So that's not being intentional by any means. It's more of, if it doesn't look like it's a good opportunity for us, I will say it's not a good opportunity for us. We wouldn't do it. Whether you think you shouldn't do it because we wouldn't do it, that's totally up to you. Everybody's got a whole different set of parameters on what they do and don't like. Anybody else? Final words? Because I'm out.
Yeah, I'll just say one last thing. Well, first off, thanks for staying on this long. I know that we've gone on an hour and a half. This weekend, this Saturday, our friends down in Houston are having their annual in Houston Multifamily Investor Network Conference. So if you are going to be in Houston, Merrill and I will be there. Please come and say hi. JC, I see you're still on. We'll definitely hook up and catch up and have a beer. But if anybody else is going to be down there, please come and find us. Say hi. Would love to have a conversation with you. And if you haven't signed up and you still have nothing to do all day Saturday and want to hang out with 600 multifamily people down in Houston, let me know. Shoot us an email and I can send you the link for you to sign up for our friends Ben and Ferris from Disrupt Equity and Kenny Wolf from Wolf Investments. So hope to see you there if you're going. Otherwise, look forward to next webinar in March. I'll let Anna end with the last words.
Thank you all for coming. It's good to see you all. Make sure that you feel free to ask questions. Again, send us an email if there's anything we can help you with, and we'll look forward to seeing you this time next month.
Thanks, everybody. Have a great evening.
Thank you.